Okay, so we're going to cover profit. We need to define some terms before we talk about profit. One is total revenue. Total revenue is the amount the firm receives for the sale of its output. Revenue, what I'm bringing in. A lot of times people mistake revenue for profit. Revenue is just what you bring in. Okay, and then we'll talk about the difference between it and profit in a minute. Everybody get that definition? Okay, then we've got total cost. Total cost is the amount the firm pays to buy its input. These inputs include supplies, workers, overhead. Everybody know what overhead is? What's overhead? It's like your utilities, like the lights, the expense of having your lights turned on, your utilities, just the everyday expenses of running a building and or a business. Okay, is your overhead. Everybody have that? All right, so then profit equals total revenue minus total cost. So your profit takes out the costs. Typically, total revenue is abbreviated TR and total cost TC. There are two ways to classify costs. Both involve opportunity costs. Okay? One is explicit costs. Explicit costs are costs required for the firm to pay some money. So if you're producing something, the cost you pay for the supplies to produce it, that's an explicit cost. The cost you pay what you pay your workers to do the work, that's an explicit cost. It's a tangible cost. Money is changing hands. Now these are opportunity costs as well, because the money you spend on those supplies could be spent on the supplies for something else that I could be earning money on. So even explicit costs are considered opportunity costs. So these are tangible costs where money is exchanging hands. Implicit costs. Costs that do not require cash outlay. Okay? These are opportunity costs. Like an implicit cost is if I am trained to be a X-ray technician, but instead I open a hot dog stand and sell hot dogs, the money that I could be earning as an X-ray technician instead of selling hot dogs is an implicit cost. Here's another example. Bob works at a factory. He's a skilled computer programmer. For everybody who works at the factory, he gives up $50 he could earn as a computer programmer. Implicit cost. It's not tangible. There's not money changing hands with this cost. But it is considered a cost. In some types of profit, which we'll talk about next. Raise your hand if you're still writing. Okay. All right. Oh, and also make note, this also, an implicit cost is depreciation. Okay, so when you, you start a pizza delivery business, and you're providing cars to your employees to deliver the pizzas, or maybe you have some kind of wholesale supply, and you're using trucks to, supply the food, and you buy these trucks brand new. Well, every year the value of the car or the truck is going to go down, right? That's depreciation, and so that's a cost that's happening without money changing hands. You don't give up money when it depreciates, but if in 5 years you try to sell it, you're not going to be able to sell it for the same amount you sold when you bought it 5 years ago. It depreciates. The value depreciates. You could talk about vehicles, equipment, machinery, all that stuff. The value is going to depreciate the longer you have it. That's an implicit cost as well, and it can be used in. I noted that because there's a free response question that they talk about this, and students didn't know about depreciation. So I want to make sure you know that. Be aware that's an implicit cost. Accounting profit versus economic profit. Economic profit is your total revenue minus your explicit plus implicit costs. Economic profit. Total revenue minus explicit plus implicit costs. Minus both kinds of costs. Economic profit is used to make production and pricing decisions. Economic profit is used by a business owner or a company's executives to make production and pricing decisions. Economic profit, well, I think it'll come up. I'll mention it later when I think it'll come up again. Then accounting profit is just total revenue minus explicit costs. Total revenue minus explicit costs. This is used for big bookkeeping. Right? This is the profit you report on your tax statements. Okay? Accounting profit does not take in consideration implicit costs. It's just explicit costs. If you're going to be an accountant, that's what you figure out accounting profit. Right? Just the profit that involves cash outlay. Anybody in here interested in being an accountant? Anybody going to IU Kelly School of Business? In here? You're going to have to take some accounting courses. I know that much. So, anyway. All right. What do you think? Which do you think is usually larger? Which would usually be larger? Accounting profit, yes. Accounting profit is always larger because it does not subtract implicit costs. If they give a free response question over profit, they will ask this question. Which profit is larger and why? All you need to say is accounting profit because it does not subtract implicit costs. Accounting profit does not subtract implicit costs. Everybody got it? All right. Is zero economic profit bad? All right. Is zero economic profit bad? Okay? Actually, it is not. It's actually normal. Okay? Zero economic profit is normal because it includes as cost, it includes the owner's salaries, okay? So, you know, it's taking out as one of the costs, you paying, if you own the business, you paying yourself some of the profit of the business, or the revenue of the business, is part of the cost, okay? So everybody's being paid, the owners, the upper management, and the employees, everybody's being paid, right? And you're producing the full amount that you want, okay? Then your economic profit, zero economic profit, is not bad. You're breaking. If you are making positive economic profit, other people will notice and they will enter your market. If firms are making positive economic profit, other firms enter that market. And if they enter that market, then there's an increased supply, so the price goes down, and the profit gets driven back down to zero profit, zero economic profit. Or if it goes less, then firms will exit till it goes back. The price goes back up, and the profits go back up. But firms will enter the market if economic profit is greater than zero. Like I said, normal profit. An economist, when they said there's normal profit, that's zero economic profit. Your price of your good equals the minimum average total cost in this condition. Any questions? Everybody got all the information? All right. Normal profit is not bad because the firm is breaking even. In order to stay in business, the entrepreneur must receive normal profit. All right. All right, we're going to stop there and do some practice. Okay, we're going to review the characteristics of perfect competition. Does anybody remember? We've discussed these. There's 4. Does anybody remember the characteristics of perfect competition? Anybody remember? Yes.
Free entry and exit.
Free entry and exit is one.
Buyers and sellers are price takers.
Price takers, yep. What else? Yep. There's many buyers and sellers. What else? What about the product? Yeah, homogeneous. Largely the same. All right, so here they are. Many buyers and sellers. Goods offered are largely the same. Firms can enter or exit the market. Buyers and sellers are price takers. Know those 4 characteristics. It'll come up again and again. Okay? Know those 4 characteristics of perfect competition. Everybody got it? No. Still writing? Go ahead. Now, some textbooks refer to perfect competition as just competitive, the competitive market. So if you see, the AP exam will use perfect competition, but if you see in the textbook or something you're reading online, they talk about competitive market, they're talking about the perfectly competitive market. No market is actually perfectly competitive, but we define it perfectly so that we can analyze it, right, at the basic level. When you get into upper levels of economics, then they add in a bunch of variables. It gets very complicated, right, because it's not perfect anymore. But to do a simple analysis, we define it as perfect, and that way we can be consistent in our analysis. Profit maximization rule for any market structure. Another thing to star in your notes. Know this rule. Firms maximize profits when their marginal revenues equal their marginal costs. Remember, economists think at the margin. When marginal revenue equals marginal cost. Any market structure. That's where you maximize profit. Everybody have it? All right. Okay. To determine profit maximization, let me put up page 327 in the book. I'll put it up here on the screen. All right, so if we have this data, and we've got total revenue and total cost, okay, we calculate our economic profit, and this is where the economic profit is highest, when it's 29. Okay, so at the quantity of, when you're producing 10, that's when you would have the most economic profit. Okay, if you graph this information, okay, your total revenue is a straight line, right? And these are this line is your total cost, right? So the total cost, at first, your costs are more than your revenue. You're losing money at the lower number of the production. And then when the total cost is farthest from the total revenue line, that's when you're maximizing profit. That would be that point. Okay? And then there reaches a point where it becomes negative again, right? When you're producing too much, you have diminishing returns. And then if we look at another way to look at it is, graphing the profit, right? This is the highest point for your profit at 10, when your profit would be highest. Okay. That's how you can look at it with total values. So we look where the profit column is the highest. We did that. Or we can compare, the other way we can do it is compare marginal revenue and marginal cost. When marginal revenue equals marginal cost, the profit is maximized. And we'll use this when we evaluate. Oh, it's not up here. Let me put it up here. We'll use this when we evaluate graphs to determine the profit maximization point. And I'll draw it up here in a second to show you how we determine that. Everybody have all this? Yes, good. Okay, so a graph of profit maximization. So our vertical axis is cost and revenue. Our horizontal axis is quantity. And then we've got our price line. It's a straight across line. Horizontal line. That's price. And the price line, this line, we call this, we're going to label this line Mr. Dark. You're always going to label it Mr. Dark. This line represents marginal revenue, it represents demand, it represents average revenue, it represents price. The demand is horizontal because the firm is a price taker, right? They're only going to purchase at the price of the market. Above this price, the quantity demanded would be 0. Below the price, everybody would want to buy it. So this is the only price. It's horizontal. Now marginal revenue equals price for a competitive firm because the price is fixed. In perfect competition, everybody is a price taker. The price is the same for everybody. So your price is going to, if you buy an additional good, sell an additional good, the change in your revenue is going to be the price of the good. And the price stays the same. So that's horizontal. Average revenue always equals price because it's your total revenue divided by the quantity you sold, right? So and that's going to be price. So that's that line. We will always label it Mr. Dark. Then we've got we would have our average total cost curve. We would have our average variable cost curve. Usually it's just average total cost, but I'm putting average variable cost on here. And then I know my marginal cost curve is going to cross those at their minimum point. Alright, so there's our marginal cost curve. And so we can, let's say at quantity 1, right? If I were producing at quantity 1, my marginal revenue is above my marginal cost, right? And that's not equilibrium because I can increase production more to increase my profit. If I sold more goods, I'd be adding to my profit. So that's not equilibrium. Quantity 2, we'll say, is here. This is marginal cost 2. Okay, now my marginal cost each time. Okay, so that's we determine our profit maximizing point. Yeah, that's it. Okay. So